Greetings and welcome everyone to the Tri-City Equity Group webinar for Lakeside Villas. I am joined by my team. I am Vince Gethings, the COO Asset Manager, Tri-City Equity Group. We have Duke Ong, CFO and CIO. We have Duran Bethea, the Key Principal and Acquisitions Director, and Jim Beasley, the Key Principal for Tri-City Equity Group as we go through this webinar. For this property, it's called Lakeside Villas. It's 152 unit, 2021 construction in Midlothian, Texas, an area that Tri-City is building a good size portfolio in. Here is our disclaimer. Please read this. Everything in this presentation is based off of the research we've done. There's no guarantees. A lot of it's going to be pro formas. The actual numbers may be different of what reality is. So if you are an investor, remember that investment does have risks to it. Be aware of those risks as you get into real estate assets and investments like this. If you're not sure, definitely consult with your attorney and your CPA and any other advisors you have before investing in an asset like this. So the investment thesis. So Tri-City Equity Group is, like I mentioned earlier, is building up our portfolio in DFW as we are selling off everything that is not in Texas. A lot of this has come from kind of the aftermath of COVID. If anyone is listening to this and has invested with us before, they know that we were in 5 different states. We had about 800 something units through COVID. We managed that. We're able to pick up a lot of data points of how different states and different areas grew through COVID. And at the end of it, around 2022, we decided we want to be all in on Texas as the best economy for anywhere where I had the best landlord and tenant laws, and had the best track record for growth and where we want to be. So we started selling off all of our assets that were not in Texas. We're going all in on Texas. And we really focused on the 50 to 150 unit size properties. We're bringing that up a little bit. We're going to start looking at mainly 100 unit plus properties. And then the second phase of our evolution for Tri-City was going after newer assets. Tri-City cut our teeth in C-class value add repositions, and they served us very well. But as we learned through COVID, we were a little overexposed in that C-class space. In our B-class and higher assets performed very well through the recessionary times and do very, very well during times of economic expansion. So looking at a portfolio, we want to balance out and do some C-class, some B-class, and now we're getting into A-class to have a great portfolio as we take advantage of the growth in the DFW market. So that's what this asset is. This is going to be the trophy asset for Tri-City, being our A-class property.
Good afternoon, everyone. My name is Duran Bethea, like Vince said, KP, and Acquisition Director, also CEO of Bands Brothers Investment Group. With that being said, I'm really excited for this property. It's just going to be an amazing journey, like Vince mentioned. But listen up, straight up. The numbers don't lie in the DFW market. It truly speaks for itself, which is why we made our decision to sell all the East Coast properties, like Vince mentioned, so that we can focus and dig deep into this region instead of spreading ourselves thin across so many different areas. DFW is home of 7.9 million people, driven by strong economic growth. Business relocated from states like California, New York. The region spans across 11 counties and includes major cities like Dallas, Fort Worth, Arlington, Plano, and Irving. DFW ranks number 1 for job growth and property investment opportunities, and is known as one of the best places for business and women's entrepreneurs. With over 4 million non-farm jobs and employment rate of just 3.3%, compared to our national average of 4.3%, this market is built for long-term growth and stability. Midlothian is just only 20 miles from Fort Worth, 30 miles from Dallas, and only a 30-minute drive to DFW Airport. Is a straight shot up. This market is the 4th largest growing metros in the U.S. and projected to add over 750,000 people within the next year. Midlothian is quickly becoming one of the best places to live in the DFW area, and it's easy to see why. As nearly 750,000 people are expected to move to DFW over the next few years, Midlothian stands out as a top choice for families, professionals, and retirees alike. One reason is for this surge is the city is perfect blend of small town charm with big city amenities with its population to set again to double within the next 5 years. Families come to Midlothian for its top rated schools, which are most the best in the state, while professionals appreciate the easy access to jobs opportunities across DFW. The city's strategic location provides easy access to the big cities around. On top of that, Midlothian commitment to enhancing the quality of life is clear. The ongoing downtown redevelopment projects, new parks, the shopping centers, dining facilities make it thriving and a walkable community where residents can work, live, and play. All right, so the 3 mile population, as you're looking here, is over 125,000 people, and the 3 mile total employments is over 66,000. Where that you got your median household income about 102,000, and right here it says the average household income is over $129,000. So when we're looking at strong, we talk about strong demographics. It's not rocket science here. When you're doing all this market analysis, right? We looking at where the jobs are going, where is the money. We check that box. We also check the box of the population growth. Okay, so Lakeside Villas is ideally, it's pretty much right along Highway 287, offering residents quick and easy access to entertainment, shopping, medical facilities, and much more. Whether it's like just when if they want to go out, dine out, go run errands, top-notch healthcare, everything is just a short drive away. That's why we like this area so much. So we went out and we went to the Economics Development Office and the Chambers of Commerce. Vince, he was just there. He had a meeting with the head, Cal, who is the head guy for Economics Development. And he brought me back some notes. And one of the things is when you're going about there's a lot of things going on and a lot of jobs, a lot of moving parts. And when you're doing your market research, when we're looking at the market research, we're looking at these heat maps and we seeing where all the population, seeing where all the growth is happening. And it's two places. It's either north of the Plano, Frisco, Prosper area, or the second area is where we located, right here in Midlothian, between Midlothian, Mansfield, right here in our backyard. So we are in the hottest market in the DFW, and it's great to be a part of this market. So I want to go over some of these things that we talked about, some of the jobs, some of the notes that Vince was able to pick up from Cal at the Economics Development Office. One of the things is that there's a commercial development currently underway in Midlothian, anchored by Lowe's. Along is going to bring about 10 to 12 additional retail stores. So normally when these jobs come, as a domino effect, it's going to bring in more jobs. So we do have Lowe's going to create jobs, going to create more restaurants, retail. The Starbucks start popping up. We have Chick-fil-A's giving more amenities in the area. Also, there is a home zone. It's consolidate up to 5 locations to one single location, which is a $50 million project in Midlothian, which is going to create about 150 jobs. Purdue Steel, which is the second largest producer of steel, just completed a 700-acre solar farm, which nearly fully is operational. Purdue, they employ over 1,000 people right here in Midlothian. Also, 2 of the 3 cement factories in Midlothian are undergoing a multi-million-dollar upgrade. Midlothian cement plants amongst the largest in the U.S. Sunrider has an 80-acre development and near completion, bringing another 200 jobs to the area. There is also a 40-acre CarMax Supercenter that has been approved. The $50 million investment will create over 280 jobs as well. Encore has broken ground on a 422,000 square foot multi-use facility in Midlothian, again, that's going to create more jobs in the area as well. And now, just last week, one of the biggest news that came out was Google. All right, so Google is expanding its North Texas Google Cloud region, which is an additional $1 billion investment in Midlothian to support its demand for cloud and AI services. Now, one good thing about it is that Google is really forcing and investing into the city. There are 40 different cloud regions across the world, all right? Google total investment in Texas is $2.7 billion, and Midlothian is going to get $1 billion of that investment. So again, there are this right here pretty much a quick snapshot of the current employees across Midlothian. but that's going to continue to grow. All right. We just talked about 7, 8 different opportunities, and every month, every quarter, there still is a lot of jobs, a lot of growth. We are in the best market. I'm really excited about this project. These numbers are going to continue to go up, guys. All right, so this slide shows the driving distance between the airport, Fort Worth, and downtown. As you can see, we've been focused on acquired properties within that 15-minute radius of each other. Again, this strategic approach aligns with our vertical integration and our Black Sands property management, where we currently vertically integrated, allow us to improve our efficiencies across all our assets.
Hi, everyone. My name is Dugong. I am the CFO and CIO for Tri-City Equity Group, and I'm going to go over the investment overview. So for our investor waterfall, we have our standard A1 shares, which is an 8% preferred return with no share of the remaining profits. A2 is a 70% share of the remaining profits, so 70-30 to LP GP. And we're introducing a new class called A3, which has a $500,000 minimum investment. And that one is a 5% preferred return with a 70-30 profit split. So the total target equity that we're looking to raise on this deal is 11.1 million. And the A1 and A2 minimum investment is 50,000 and A3 is 500,000. We have it under contract at 27.588 million. And we plan on deploying about a little over $1 million for the closing costs and 1.14 for the CapEx and reserves. The great thing about this deal is it's a HUD loan that we are planning on assuming at a low fixed rate of 4.02, so much lower than current market rates. And not only that, but at a great LTV, which is 71%. And if you've been investing in our previous couple deals, they were also loan assumptions, but much lower LTV, which means we had to raise more equity for those deals compared to this one. For our fees, we are charging a 3% acquisition fee, 1% of the equity for the asset management fee, but no refinance or disposition fee. Our value add potential is to raise rents about 10 to 16% to current market rates for this vintage. And the property consists of 152 units, 64 one-bedrooms, 56 two-bedrooms, and 32 three-bedrooms. And it was built in 2021. Our cost seg study preliminary numbers show a substantial passive loss in year one. And currently, the law shows 60% bonus depreciation for year one in 2024. And that works out to be about 33% of the investment amount in year one and a total of 74% over 5 years. And there's some talk of the law changing back to 100% bonus depreciation, depending on what happens in the political arena. And if that were to happen, then in the first year, if it was 100% bonus depreciation, it would be 54% of the investment amount in depreciation and about 77% over the 5-year hold. However, the depreciation is only one part of the calculation for the net loss to our LPs. So the operation, which is the profit and loss, will need to be taken into account to arrive at the actual passive loss. All right, so for the capital stack, we have the senior debt that we're assuming, the HUD loan, at 71% LTV. And above that is the A1 class, which is preferred equity. So preferred equity means that A1 gets paid first, just like a debt term, at 8% cash on cash. So for that one, there's no share of the profit split, but it's paid first. So it's safer on the capital stack. And then the common equity is the A2 and A3 shares, which is 70% of the profit split. And our GP team is planning on investing at least 10% of the total raise. So the deal structure is TEG Lakeside LLC will be the owner of the property, and that will consist of the LPs or individual investors. And it's going to be managed by TEG Lakeside Management LLC, which is the GP. For the waterfall on the cash flows, first we're going to pay out the A1, so the 8% preferred return, and then the A3 at the 5% preferred return, and then the 70-30 split between A2, A3, and GP. On both refinance or sale, first we're going to pay the A1 at 8% preferred return, and then a return of capital for A1, and then A2 and A3 at return of capital, and then the 70-30 profit split between A2, A3, and the GP.
All right. Thanks, Stu. So going over the business plan, we'll do a quick recap of Lakeside Villas or why we love this deal. 152 unit Class A property, Midlothian, Texas. This was an off-market find from Duran and his team through our broker relationships. So that's why we're getting, one of the reasons why we're getting such a good deal on this is it is an off-market deal. One of the other things I love about this is the cost basis. So if anybody has been watching real estate transactions lately, the market's generally at a 10 to 20% discount versus 2021, 2022 highs, especially in the DFW area. So we are getting a significant discount based off of where this property would have traded or what it was valued at just a few years ago when it was finished construction. So it's given us a fantastic cost basis, which is making it a much safer deal for us. The favorable terms, this is going to be a HUD loan transaction or loan assumption. Duke just went over the terms. We don't need to go over that. But having long-term fixed rate debt, non-recourse, is fantastic for us as well and our cash flow. And this is going to be eventually wrapped up under our vertically integrated company now, Black Sand Property Management. And I'll talk about that a little bit here in a second. But being vertically integrated gives us a huge advantage over other operators, other assets, and our competition because we can be a lot more agile and a lot more efficient in the way we conduct our business. We talked about how this property fits perfectly into Tri-City Equity's new portfolio vision, going after the bigger, nicer properties to help anchor our portfolio and balance out with some of the other assets we have, C-class and B-class assets. This property being a 2021 construction, they did outstanding floor plans with very modern units. They're well equipped. They have granite countertops. All the units have in-unit laundry. All of them have good quality building materials and things like the cabinets and such that we look for. All the HVAC systems are good quality. The unit mix at this property is fantastic. That is one thing that Tri-City has definitely learned as we get to know the DFW market more about how important unit mix is here. And then the amenities at this property are top notch. We got the community center, we got the fitness center, we got the pool, we got the dog park, the playground, we got the expansive footprint so people can walk around the property, and it looks very nice with the trees and the landscaping and such. So this property has everything. What that means for us is that we don't have to put a whole lot of money in capital expenditures up front into the property to do those things which we normally do, is have to put in the dog parks, the barbecue areas, the playgrounds. Here, we don't have to do any of that because the property is very well equipped right out of the gate for us. It being a 21 construction, a lot of this stuff, the major systems are still under builder warranty. So we're still in the process of reviewing all those, but some of those are going to be transferable. Things like the roofs, the HVAC systems will be transferable to us for the rest of that warranty term. So that will help lower our expenses during ownership as well. So as we get into the acquisition phase, like I mentioned earlier, we do have property management company now, Black Sand, which is our vertically integrated company making us owner operators. However, because this is a HUD loan assumption, we have to apply with HUD compliance rules and things like that. And Black Sand has yet to check the box for experience in the eyes of HUD. So we have to partner with an outstanding firm, Capstone Real Estate Services. They have decades of experience and is actually a preferred receiver and preferred property manager for HUD and other agencies like Fannie and Freddie. So we are going to partner with Capstone Real Estate Services. They're going to take the lead on property management during the acquisition phase. Black Sand is going to sit right seat on them, learn everything we need to do on how to do the compliance and reporting for a HUD loan. And then around the 12-month mark, Black Sand should qualify to take over as the lead operator on the property. So that is the acquisition phase of this deal, is we're going to be left seat, right seat with Capstone Real Estate Services. But during takeover, we'll follow our normal checklist and normal protocols. We'll be reviewing all of the contracts, see where we can renegotiate some of the things like landscaping and pool services and all of those types of things, see if we can renegotiate those, bring costs down. At the same time, our management team is going to be evaluating all of the current residents, making sure that they are compliant with all of our requirements and getting a good feel of who our resident base is during that first 2 to 3 months of ownership. As we move down to the renovation phase 1, since this property is so new, we're not going to be doing the normal stuff that we normally do, like dog parks, playgrounds, and stuff like that. But there is some exterior improvements that need to get made, mainly things like landscaping and gutters, downspouts, and those types of things that need to get repaired and tuned up. And as well as the exterior branding, we want to make sure that we represent well with Tri-City and Black Sand and stay on our brand and make sure the community knows that this is a Black Sand property, right? Then we'll be going into the lease renewals. I call it Generation 1 lease renewals. That's when we do the entire lease audit and we do the first bump up of everybody up to market or way up to market or whatever we decide. And that is getting everyone over to our leases to make sure that we're not using the inherited prior owners' leases. We want everybody on our leases to make sure we know what's in the lease and we can hold the tenants accountable to our leases. So that's the Generation 1 lease renewal plan that usually happens in the first 4 months. Then we go into renovation phase 2. We're going to be adding a little bit to the pool area, making it really like resort level finishes on the pool. The pool there is very, very big. The pool deck is very, very big. And we want to add a sunshade feature like a pergola, add in new furniture, and really make it seem like they just walked into the Four Seasons. That is the potential that this pool and community center has. And that's what we're doing there for the community enhancements. There is some things like I mentioned earlier, the exterior upgrade and parking garages that need some fixing to make sure we can fully capitalize on those. We're actually going to try to get the owners to help fix some of that stuff prior to closing. So it may not even be on us. And then phase 3 is when we're going to be doing the Generation 2 lease renewals. That's going to be bringing the rest of the residents up to market rate rents. We start stabilizing and seasoning our rent roll, seasoning our T12. And that's when we're going to start looking out there for the market and talking to our brokers, seeing where we're at in that market cycle. See, we're on that up wave up to the top of the market and maybe planning and strategizing for our exit, whether it's a sale or a refinance. Here's a quick timeline recap. I'm not going to go over this line by line because a lot of it's just a recap, but you can see how we have our closing deadline at the end of October. Phase 1 is usually 0 to 3 months. Phase 1 acquisition, phase 1 CapEx, 3 to 12 months. Phase 2 is that 12 to 24 months. And that exit timeframe is normally around that 3 to 5 year mark. And for that, it's really, you're just trying to time the market to see where we're at, make sure we get a good exit to maximize our IRRs. All right. So things on the bottom here with these bottom tiles are the things that make Tri-City very competitive is how agile we are to market changes. And we use AI automation. We are vertically integrated with Black Sand Property Management Group. That's in-house. We have our own in-house maintenance, in-house property managers, in-house leasing agents. That makes us very, very quick to make changes and adapt to markets and also keep costs way down. We do multi-domain marketing. So we're on Facebook. We're in the Facebook group, studioapartments.com. We do Zillow. We have virtual assistant and after hours support that has helped doing our branding and posting all hours today. So 24-hour support on marketing, make sure our ads are always up to date and on top of all the feeds of local Facebook groups. We use things like Rently and Tenant Turner and Code Box. Those are contactless self-showing technology. So it's a code box that we can put on the doors. So if a lead works late or works on off hours or can only show up on 8 p.m. on a Saturday, we can still capture that lead and convert them into a lease by having 24 hours around the clock ability to show units. Virtual staging and doing things like Matterport scans as well really help our ads pop compared to our competitors and get more clicks, get more conversions into appointments, and therefore more applications once we can get in front of them with our sales teams. And then we use things like Rhino, Liberty Rent, Jetty. What those are security deposit alternatives that reduce the barrier of entry for people coming in so they don't have to come up with the first month's rent and a full security deposit. They can do the prorated rent up front, and then they get a Rhino surety bond or like a Liberty Rent, which is kind of like an insurance policy that if they start struggling on the rent, Liberty Rent will kick in and pay us up to 6 months of rent. Or if they damage the unit on move out and we do our move out inspections, Rhino or Jetty are surety bonds that'll kick in and reimburse us up to $2,000-$3,000. And the tenant didn't have to come out of pocket, but only a couple dollars a month to secure those policies. So that is another competitive advantage we have that our competitors aren't doing a lot of, which gets more people applied for us because our barrier to entry is lower compared to our competitors. All right, CapEx. This is our working CapEx budget. So it won't be more than this. We are trying to get some credits on some of these, or at least have the seller fix some of these items before closing, which will most likely happen. But I wanted to plan for the worst, and that's this budget here. So again, not really anything major here as far as upgrades. A lot of the interiors are going to be our standard make readies budget there. And then the exteriors, a lot of that is those repairs and things like that. The drainage, the landscaping, the garage repairs, pool repairs are going to be the major items there for our CapEx budget. Right. And the exit strategy. So right around the 3-year mark is when we start bringing the brokers back onto the property, show them what we've done, start sharing our financials and rent rolls with them. And they will start running their, which is their opinion of the value given the current market conditions. And they will start having those conversations around the 3rd year. And then from there, it's usually quarterly or an ongoing conversation with our brokers from there to about exit time. We always underwrite to a 5-year hold. That keeps it all offerings kind of apples to apples, even though most of our exits happen around close to that 3-year mark. But that is our exit strategy. We'll either do a refinance or a disposition. And we start that conversation on 3-year mark. And because we have the long-term fixed rate debt, we don't have any market pressure to exit this deal prematurely when it's not right for us and it's not going to maximize our return. So that's very, very good for us on this deal.
Okay. Thanks, Vince. Appreciate it. Jim Bisley here, one of the principals for Tri-City Equity. And we're going to talk about the rental comps, pretty exciting areas right here. If you take a look at this map right now, you can see the 3 best comps that we could come up with for Lakeside. They're actually all older properties. And if you look at the comp sets, you can see that they're all actually priced a little bit higher. Currently on the Lakeside Villas, you can see the current rental values that we're getting, and we believe that we're going to get on average about $250 more per month with the capital expenditures that Vince was talking about, making this a nicer property, also marketing it better for sure. If you look at the Mark, if you look at 9th Street, and if you look at Magnolia, all 3 of those are from 2000 to 2018 and 2019 vintage properties, where Lakeside is actually a 2021 vintage property, definitely a superior property in my mind. So we should be able to get the rent and comp sets much higher. So that's really good for us when we're looking at these maps. And also sales comps, because this was a off-market sale, we actually got it what we all feel is below market. If you look at the Main Street lofts at 190 a square foot, sold in 2023. If you look at Audrey apartments, sold in 2023, 2021 vintage, probably one of the closest comps. And if you look at the Grand Crossing, sold in 2022, also 2022 vintage. If you look at those, the only one that has a direct comparison is the Main Street lofts, around $190 per square foot. Audrey's probably one of the better comp sets that we can use at $216 a square foot versus $190 for Lakeside. So we feel that we've picked up this property for a much better deal, and it's an off-market deal. So very exciting from that standpoint.
All right. So I'm going to go over the pro forma. So based on the business plan and executing the CapEx that Vince had mentioned, we are looking to push the NOI from the current number of a little over $1 million to about $2 million in year 5. But of course, the timing of the exit will depend on the markets, cap rates, and interest rates. Primarily, we're going to drive this through better spending and also pushing up the rents to market rates. So for projected returns on the A1, you're looking at just straight 8%, and then A2 is about a 98% total return. over 5 years. So cash flow is pretty decent and throughout the whole hold, but the majority of it will come at year 5. For occupancy stress, we are in the low 70s for break-even occupancy, which is excellent for risk mitigation. So what that means is we can get down to as low as like 72% and still break even. And for the minimum DSCR, it's in the 78 range. So that's also really healthy for risk mitigation. In our sensitivity analysis, we're looking at exit cap rate versus hold period. And our base case is a 5 exit cap rate in year 5, which results in a 15.8% IRR. And that will range from about 11 if the exit cap rate shoots up to 5.75, up to a 21% exit cap rate if it compresses to 4.25. For our track record, these are some of our earlier deals as a sample, but we have had 7 full cycle exits, 5 of which were syndications and 2 were JVs. And on our 5 syndication full cycle exits, our average hold time was 2.2 years. Equity multiple was 1.74, so 74% total return, which if you divide by the 2.2 gets you to 35% total annual returns and about a 28% IRR. All right, for the investor experience, we are using a new investor portal on this deal called Cash Flow Portal. So that will be the first step, is to go to Cash Flow Portal and register. And then you would reserve your shares. 50,000 is the minimum investment for A1 and A2. Then you create your investor account, enter your banking information, then e-sign the subscription agreement along with the operating agreement. And then you would fund via wire or ACH. And then once it's time for distributions, you would receive distributions via ACH. For reporting, we do monthly webinar updates for the first 12 months, and we provide detailed financial reports every quarter. And we strive to get K1s out to our investors by March 31st for the prior year. So again, my name is Duke. I am the Director of Investor Relations and CFO for Tri-City Equity Group. And I'm also a PB of a real estate firm, Blueprint Real Estate Advisors on Oahu, with over 48 million in career sales.
All right. Thanks, Duke. Again, I'm Vince Gethings, the asset manager for Tri-City. I lead most of the development and execution of the business plan. I'm helped by John Harris, who used to help me being asset manager, but since we have launched Black Sand Property Management Group, he is the president of that company, and he handles the team here for Black Sand, as well as the daily operations of our DFW portfolio. And then under Duke there is Steve. Steve is one of the original co-founders of Tri-City. He helps a lot with the inspections, as well as managing all of the insurance policies and compliant issues with insurance, as well as helps with some of the marketing, online marketing presence as well.
All right, again, Deron Bathay here, also the CEO of Banzer Brothers Investment Group, where we own multiple companies from fitness to property management, luxury vacation rentals, starting out new treasure studios as well, partnering with Jill Beasley. And it's been great. Also, like again, I've been retired for about 20 years as a chief warrant officer 4. I've been retired for about 2 years now. Bob is the acquisition manager who's pretty much helped me assist doing a lot of market analysis, research, running all the reports. He also has his company, B&B Advisors, who specialize in commercial retail, who specialize right there in the Dallas market. But yeah, that's our team. I also want to mention, those of you that are watching this is our currently just going to be a public offering, meaning that this will be a 506c offering. So we currently, like Duke and Vince mentioned, we sold 2 properties this year, returning about $10 million into as far as investor capital back. So we anticipated this to go really fast. It's an $11 million deal, but just in this year of 2024, we returned $10 million of that, and we have investors on the sidelines. So the reason I'm bringing this up, by this being a public offer, it's going to be available to the public. So if you currently watching this and you have family and friends that may be interested, please make sure you reach out to one of these guys that you send here. Make sure you reach out to them, schedule an appointment, because this is our first time that Tri-City is bringing this to others outside of family and friends.
Thanks, Dee. And my name's Jim Bisley, one of the key principals as well. Senior to everybody else in terms of age, junior to everybody else in this group from a multifamily standpoint. I think everybody here has more experience than I do in the multifamily sector. I couldn't be happier and be more proud to be involved with the partners that we have in this group. Every time a deal comes across, it is so overanalyzed that I don't have one additional question. But what I've done for the last 25 years is the second largest vacation rental manager in the United States, about 800 properties in my portfolio with about $1 billion of assets under management, and have recently joined a group that we now have 8,000 properties in 30 destinations around the United States. That vacation rentals has always been very exciting to me. These opportunities have been amazing. This is my 8th multifamily opportunity with the group, and averaging about I think about 32% a year IRR, or return on investment. They know what they're doing and they've done an amazing job. So I couldn't be prouder and happier to be part of this group.
All right. So if you're interested in joining us on this deal, please click the link in the email or in this deck in order to jump into Cashflow Portal and reserve your shares. And we look forward to partnering with you.